GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's more reliable than your can't lose meme coins. I'm your host, Jay Hamilton, and it's Friday, February 21st. Today, we are joined by Avichal, investor and co founder of Electric Capital, a leading crypto VC firm with investments in Kraken, Bitwise, Near, and many more projects that you guys would know. Also, previously worked at Facebook and Google. Today, we're going to talk about where are we in this cycle? What is the VHLC coming next? Meme coins, are they good or are they bad? Why do we have so many L1s? Do we need this many L1s? Is there still value to accrue to L1s? Or is the value going to start to shift to apps? We're going to talk about fundamentals versus pumpamentals because we talk about that every day right now. Also, at the end, we're going to talk about AI. Is crypto and AI real use cases and real projects? Is it underhyped or overhyped? Is it all vaporware? We're going to break that all down. Before we jump in, guys, I want to connect with you on a more day-to-day basis. So we just started a Telegram group where you can get direct access to me and the rest of our team. So click the link in the show notes, join the Telegram group. We'd love to hang out and spend more time with you guys. Today's episode is brought to you by Crypto.com cards, one of my favorite cards in the space. Check them out if you haven't already. Without further ado, Avichal, welcome to the Milk Road Show.
Good to see you. Thanks for having me.
Yeah, great to see you too, my man. Look at us both in the West Coast, green in our backgrounds. And it's a bit, I don't know about you, but it's a bit rainy up here today. But you know where it is really raining today is on ByBit. Let's start with that. So news came out this morning that ByBit was hacked for 1.4 billion. One of their cold wallets, their ETH cold wallet, was hacked. 1.4 billion gone instantly. Holy shit, I can't imagine being a founder and waking up to that. What are your initial reactions to this news?
A couple of reactions. One, man, it's the post-mortem will be really interesting to see how this kind of happened. And I've seen some early reports sort of streaming out this today about kind of how they sort of somehow compromised multiple signers' devices and gave them a UI that sort of showed a transaction ID or a destination that was not the actual destination, and then ended up taking the signature and sending it somewhere else. But it'll be sort of interesting to see kind of what we can learn from like an OPSEC perspective there. I mean, frankly, I think the ByBit team is doing a pretty good job on the postmortem right now. Like they've been super responsive, they're transparent, they're sort of tracking it down, they're sharing information. I think they're doing about as good a job as they can. And they're claiming, which there's no reason to doubt them. It's a phenomenal business. They're claiming that they're solvent. So if people want to do withdrawals, that this wasn't like user fund related, yada yada. So. But it's still a $1.5 billion hole, and wouldn't be surprised if that results in some degree of the hackers already sort of disposing of the assets on dexes. So I wouldn't be surprised if that creates some downward pressure on the price. But then ByBit probably has to buy it back. So so I think it's all a wash on that.
That's exactly, yeah.
But
we've seen, I think about 200 million has already been sold from this hack.
Yeah. Well, what's about that too is it's going through the dexes and it's going through all the decentralized infrastructure. So they're not routing it to sexes like they have in the past. So the centralized exchanges are just sort of getting sidestepped, and it doesn't look like, at least last time I was looking, it's been maybe an hour and a half since I looked, but they weren't really touching the centralized stable coins either because they didn't want to get shut off, and so just parking assets in that. So it's kind of like actually. It's obviously very unfortunate, but it's kind of an interesting stress test of all the decentralized infrastructure and the degree to which it can sort of maintain this volume or sort of actually be permissionless. It's kind of interesting to see it sort of play out.
Are you worried about ByBit? Are you worried about this causing larger contagion?
Not yet. I think they seem to be handling it well and professionally. It doesn't seem to be a like house of cards situation quite yet. With these kinds of things, you always, the thing that sort of can tip it is if everybody just en masse starts to withdraw, and then you might have a problem. But it doesn't look like that's the case right now. I mean, they've seen some net outflows, but it doesn't look like it's not like an SVB situation where sort of your assets and your liabilities may not match up in the short term. It doesn't seem to be the case yet. And so I'm not anticipating too much contagion here. I mean, I think the fact that the market is sort of not, puking all over this right now it's actually like it seems fine. Like there's a little bit of a reaction and it sort of bounced back, and so I think the market is sort of will digest the ETH as it gets sold, and ByBit. ByBit's a really profitable business. So they'll be able to patch this hole soon enough too.
That's yeah.
But
That's how I feel. ByBit's a partner of ours, so I
mm,
feel for them. It's just awful to go through something like this. As you said, also I'm very interested in the OPSEC side of this to see what actually happened.
yeah, what they're learning
So
from.
hopefully everybody can learn and we can make sure this stuff doesn't happen again. But I hope it feels like everything will be okay. If you do hold money on ByBit, not financial advice, don't want to tell you to do it with
Yeah,
your
yeah.
money, but don't go withdraw everything. If everybody withdraws all at once, then
Yeah, that's
this
that's what
could
creates an issue, right? Is actually the
that
fear,
would
not
create
the
an issue.
yeah,
Yeah.
yeah, yeah, not the
Okay.
input.
So hopefully we're all good and we all wake up tomorrow and throughout the next few weeks and this doesn't affect us at all. Let's talk about where we are right now. So we're 7 weeks roughly into 2025. Trump's been in office for almost exactly 30 days. What's your thoughts on where we are right now in the cycle and the market?
Well, a couple ways to slice that. I mean, you mentioned Trump. I mean, from a regulatory perspective, kind of uh, doing exceptionally well. I mean, the news this morning, if you were watching, was the SEC lawsuit against Coinbase was dismissed, and Brian Armstrong has a great tweet about kind of the history here and kind of how he feels. And I think Brian deserves a ton of credit for standing up for what was right. It cost them tens of millions, maybe $100 million to sort of fight here, and they won. And so, if you don't follow Brian Armstrong, go read his post. And I think I think the whole industry owes them a debt of gratitude for fighting. I think Brian and Paul and Emily, Paul Gruel, who's their chief legal officer there, and Emily's their COO. I mean, they decided to sort of double down and spend a lot of money for what they thought was right, and came out ahead and they won. But even beyond kind of the SEC lawsuit kind of stuff, if you look at the Trump executive order, asking the agencies to look at the rules that impact crypto and come back with recommendations. Getting rid of SAB 121. It looks like a stablecoin bill. Maxine Waters has drafted one now, and it's ready now to be discussed. And that's actually a really big milestone for people that don't follow politics or policy very closely. The Senate already had a draft version of the bill with Senators Lummis and Gillibrand from New York. And Senator Haggerty and Tim Scott signed on to that and have a modified version of that. So probably good momentum in the Senate for a stablecoin bill to get through. And on the House, the challenge was always getting out of committee. And Patrick McHenry had done a really good job on this and had a bill proposed. And now that Maxine Waters, who's the Democratic lead on that committee, has one too, now you can actually start to make progress. You can have a substantive conversation about kind of how this is going to work. So kind of, actually stepping back for a second, right? If you think about the state of crypto regulation, let's say as of December 24, you could kind of segment it into the world and the US. And actually for a lot of the world, things have been trending quite positively for some time, right? It wasn't perfect, but a lot of jurisdictions, whether it was in the Gulf or in Asia or Europe or LATAM, they basically looked at this and said, you know what, this is a technology stack that we should put some rules around. And ideally, if we put in good rules, then we'll have companies that want to be here and our businesses can do well. And I think it was essentially a learning for those jurisdictions from the internet, where a lot of these countries effectively lost on the internet, right? If you just look at all the major companies, whether it's Amazon, Facebook, Google, Nvidia, they're all American companies. And so I think these other jurisdictions sort of feel this pain very acutely. They're like, hey, how do we really have any leverage here? How do we really get the CEOs to show up? How do we exert influence? And their hands are a little bit tied, right? And so I think when they saw crypto, they said, oh, this is an opportunity to try to figure out how to win here. And I think they're trying to do this with AI as well, though I think far less successfully, because the issue in AI is not regulatory clarity; it's other issues. But in crypto, one of the blockers was regulatory, and so by creating clear rules and having fast regulatory action, I think these other jurisdictions were out ahead. And so if you go to the other part of the tree, which is the U.S., you kind of zoom in there. The blocker was really, if you look at the three branches of government, was not judicial. Like the courts have actually been ruling mostly pro crypto. If you look at a lot of these cases, it was really a combination of the White House under President Biden and sort of the direction that they were getting from the left part of the Democratic Party that was creating a lot of issues in Congress. And so you just had the process both on the legislative and the regulatory side was just really gummed up for the last 4 years. So we just didn't make progress for basically 4 years. And we sort of had this like weird snapshot in time of what people were doing basically from like 2019 is kind of like where crypto got frozen in regulatory. And now we've sort of unfrozen that, right? And so now we've sort of made a couple of years worth of progress in basically a month in terms of clearing old deadwood and clearing out old cruft. And cleaning up the SEC. And I think we're now at the point where we should have been, frankly, 4 years ago, which was, okay, let's figure out what the rules are. Let's have that conversation. Let's decide what's in bounds and what's not in bounds. And let's decide what the rules are. And let's decide how we figure out what is a security and what isn't a security. And let's figure out how the banks can participate here and what are the disclosure, how do we protect consumers in the right way? Like, we can actually start to have a productive discussion about this stuff is like finally where we are now. And so I think we've made actually a tremendous amount of progress in 30 days. It's actually pretty remarkable how much progress we made in 30 days.
It's from that lens, it is so true. The thing is, right now, people aren't looking at that lens, especially not retail and not a lot of our listeners. The lens that they're looking at is, I keep on grabbing meme coins and they keep on blowing up.
Yep.
There's a lot of negativity in the space. Solana's getting slammed as a result of all this meme coin action. And it's becoming, there's a lot of noise. There's a lot of noise and a lot of bearishness. Are these meme coins good or bad? Let's just ask that direct question.
The short answer to that is they're bad, but I think that they are inevitable. And what I mean by that is, I think I've come to believe that speculation is just a necessary part of markets. Like, I think arguably, what is venture capital? Venture capital is a lot of speculation, right? You're taking very far-ranging, forward-looking bets with very limited information, and so speculation is actually an important part of bootstrapping the market. And so I don't think you can really say that they're sort of, maybe the question isn't are they good or bad, but it's, if we know that speculation is going to exist, how do we contain the damage without losing the really good side effects of the speculation? So, I mean, if you go back and you look at the railroads, or you look at telecommunications, you look at the internet, I mean, like, all of these things had a lot of speculation in the early days as people figured out how do we even value these things. And I would argue AI is sort of going through this right now too. Like, a lot of companies that are AI companies are not going to be able to live up to the hype, though. And as NVIDIA might be able to, but I think a lot of other companies are going to struggle. How do you sustain these valuations with these revenue numbers? And that's not universally true. There are absolutely some phenomenal AI companies today doing real revenue, but there are a lot that are really overvalued, and there will be an implosion. And so I think the question always is, okay, we know there's going to be speculation. Out of the speculation comes a lot of really useful infrastructure and technology, because you get an overinvestment into areas that otherwise would not have gotten that investment. In the case of crypto, this is distributed systems, cryptography, zero knowledge proofs, trusted execution environments. There's like real stuff that's been built here that's really useful, that probably otherwise would not have received funding at the scale that it did. And so the question really is, in my mind, is not so much are meme coins good or bad, but we know something like meme coins is going to exist, has always existed, whether it was DeFi Summer or ICOs or what, Bitcoin forks. The question is, how do we create an environment where the speculative stuff is sufficiently minimized and the really good stuff is maximized? And I think the way you do that is you create an environment where people can make really, really good decisions about what's happening. And so, information flow out to the people who need to make these decisions about where to put their money, so they can understand what's real, what's not real, which teams are committed and not. Having industry norms around, which of these businesses are real businesses versus which ones are just speculative. Which of these founders are here for the long haul? If there are bad actors, how do we call them out? There are a lot of open questions about how to contain the damage, I think, that we need to work through, that we haven't been great at, I think. Either from the regulatory side or from inside the industry, that we could do a better job of. But the meme coin thing to me is like a little bit of a red herring. It's like, they're going to exist. If it's not meme coins, it's going to be something else, right? And so the real question is, how do we give people the right information? How do we help them make good decisions? How do we call out the bad actors? How do we prosecute the bad actors? And how do we make sure that the maximum amount of money flows to well-intentioned builders who can really create real value over the long term, of which there are plenty. They just get drowned out sort of in the noise.
Hard thing to do, right?
Super
Like, I agree. I fully agree with what you're saying, but very tough to do when the nature of the meme coin investor is a gambler, and a gambler doesn't. The nature of gambling is not having a lot of information and not doing a lot of research. It's it's making bets with not a lot of information because you're trying to get rich quick, right?
Yeah.
So,
well, that's also a really interesting point here too, right? I think there's sort of this notion of like, people, it's a zero sum game. It's very PvP. Arguably, it's even worse than a casino. Like, a casino is really smart about bleeding you slowly, and having enough winners come out. So, you're talking like 49-51 odds. Whereas a lot of these meme coins are probably like, 99-1 odds. Like there's just no way you're going to win. You're going to lose most of the time. And almost certainly you're losing. And even when you win, there's no liquidity to get the money out. So on and so on. But I would I think it's interesting to sort of think of the question here of, do people understand what they're doing? And I'm not deep enough in the meme coin ecosystems to really have an understanding of this, but I don't think people think that meme coins are a good investment. Like, I don't think people are going in and saying like, oh, this is the next NVIDIA most of the time. Now I think there was some of that with like the AI meme coin kind of hype, but by and large, I think people are saying like, yeah, I get what I'm buying. I'm buying Whiff, or I'm buying Bonk, or like they kind of know that they're playing a game here. And so I think in some sense it's actually it's okay, right? Like if people understand what they're doing, like the problem I would have is if what you have is a bunch of uninformed investors making or retail, it's hard, struggle to even call them investors, but uninformed retail buying stuff and they think that it's a good investment, right? If what they have is a meme coin, but what they think they're buying is an investment, that's a problem. If what they have is a meme coin and they know they're buying a meme coin and it's probably going to zero, like that's kind of like buying lottery tickets, right? Like it's people know what they're doing and there are reasons for them to do it, which are somewhat rational. I think that's okay actually. Like I had this great conversation with I think I've told this story once before somewhere, but I had this great conversation with this guy who was stocking the shelves at a grocery store, and I think I was wearing like a Zcash shirt or something that like Zuko gave me years ago, and it's just like happened to have it on, so my gym shirt. And he saw it. He's like, "Oh, are you into Zcash?" And I was like, "What? Like, how did you recognize this logo?" And we started talking, and he's actually very rational about this stuff. He was like, "No, I get it. It's just like, look, I don't make that much money. I can't save that much money. If I'm like really diligent and I don't like go out with my friends and like if I just like don't buy any alcohol this year and like I just save, maybe at the end of the year I have like $1,000 or $2,000, and like great, I do that, and then what? Like my life is not any different if I have $1,000 in the bank. And but maybe if I buy one of these things and it rips and I get $10,000 or $20,000 out of it, then that's worth it. And so if I either end up with zero and my life is exactly like it is if I have $1,000, or end up with a lot more money and that is actually a meaningful difference in my life. And you're like, well, that's kind of rational. Like that, he's not a dumb guy. Like he gets what he's doing. He understands the game that he's playing. So again, sort of this like bad versus good, I think is sort of like I don't think of that question. The question I think about is like, do people understand what they're doing? If people understand what they're doing, I think it's fine. And I actually would argue if people understand what they're doing, which is a big if, I think you could argue that a lot of these people don't understand what they're doing, which I think is a separate discussion. But if you sort of say, what, people know what they're doing, I actually think it's kind of good if you grant that. And the reason is because what people are learning, this is like it's a financial game, right? And so what are people learning? They're learning about how to do self-custody, they're learning how to use these wallets, they're learning about cryptographic signatures, they're learning about things like inflation and like staking rewards, and kind of like money doesn't come from thin air. Like if it's being staked, somebody's getting inflated away. They, if they get front run, then they got to learn about like, wait, why did I get front run? Or, what is MEV? Like it sort of opens up all these questions. And it's not to me that dissimilar from what happens with every generation of technology. You sort of have games as the bootstrapping mechanism. And so we've talked about crypto of like, oh, they're going to be crypto games. But I think people pattern match a little bit too much, where they're like, oh, it's going to be a video game. It's going to have pixels and like a first person shooter or something like that. And actually the game is meme coins, right? Like people are just burning money on playing games. But like what's happening as a result, I think, is they're actually getting way up to speed on this new financial infrastructure. And then what happens after they lose money is they sort of sit back and they say, well, what should I have done to not lose all this money? And very quickly they learn that there are these sort of pockets of fundamental usefulness. I had a conversation actually once with the Magic Eden guys, and we were talking about this around NFTs, and I was noting, what's interesting about core crypto, like DeFi or the ICO bubble, was that even though people are doing very speculative things and losing a bunch of money, like 10 or 20 or 30% of their assets ended up being in like Bitcoin or ETH, and then they probably forgot about it. And then a couple years later, they came back, and they actually, in US dollar terms, because Bitcoin went up 5x, they were kind of like, okay, right? And so then everybody, like the bootstrapping mechanism is everybody goes back and they think about it and they're like, oh, wait, why did I waste all of my time to just underperform Bitcoin or ETH? Like I should have just like bought the good stuff, not done all the stupid stuff and wasted my time. And I would have done better. And so what you actually do is you like bootstrap an entire new generation of people into, oh, I should just hold Bitcoin. Or I should just like buy ETH, or I should like, there are a handful of things when I look back that are like were actually useful, and the founders were smart and well-intentioned and good. And I should have just bought those things and like not done all the other stuff, or I should have sized it appropriately. Like I could have done that with like 10 or 20% of my stack. I probably should have done it with 90% of my stack. So I think as long as people understand what they're doing, it's actually can be like a phenomenal bootstrapping mechanism into actually understanding the space and understanding like good investing.
Yeah, I hope it goes that way. If it goes that way, great. If it's a gateway drug or an entry point, then fantastic, because it gets you in. So long as people don't leave.
Yep.
What I hate to see is people get wrecked and then they rage quit and they leave and they never come back. That's concerning, obviously.
Yep.
And then also, so long as people, as you said, they are willing to take a step back and learn from their mistakes and say, hey, okay, that didn't work out. And look, to all the people who invest in meme coins and have done well, like all the power to you, great. But there's a lot more losers than there are winners, and we all know that. And if you've lost and you take the time to say, okay, how can I do better? Because I gotta say, that guy who's stocking shelves, I want to say to him, like, put it in Bitcoin, man, and learn compounding investments and understand that. And look, maybe you're not gonna be rich tomorrow, but 20 years from now, 50 years from now, you will have changed your life and your family's life and your kids' life. So that would be, anyways.
It's funny. That's literally what I told him. I was like, dude, what are you doing? Just like buy Bitcoin every week. Don't screw around, or at least like take half of what you're doing and just like go buy some Bitcoin every week, and you'll probably be way better off.
Because there's a reason that the lottery is the lottery and only one person wins. Not everybody can change their life overnight, and so reset your expectations. Okay.
Well, I think the other thing that doesn't get talked about here too, which is why I think like the meme coin stuff is a little bit of a red herring, is like there's a reason people are doing this, right? Like, which is the system is fundamentally broken, right? And if we have entire generations of people feeling like they can't participate in a system and that their lives will be better than their parents' lives, we kind of fucked up somewhere, right? Like something actually, like meme coins are the symptom. That's not the root cause. The root cause is like the economy is fucked and upward mobility is fucked and wealth inequality is a problem. And like all of these other things are the actual problem. And so we have this little bit of like a scapegoat, but that's not really the issue. The issue is like, why is our education system broken? Why can't people get good jobs? You know, why is wealth inequality the way that it is? And like those are the things, and we fix those things, then I think like the meme coin stuff kind of like goes away on its own. Like we're just sort of, we're talking about the symptom. We're not talking about the root cause in the first place.
This is why we need the other show that we were talking about before we started recording, addressing the symptoms and getting to the root causes and talking more about the ethos of technology and how technology fits with humanity and the differences that can make. But we won't go there today. That's for another time. I want to shift gears slightly. So a lot of our listeners and a lot of people who invest in crypto, other than those in the meme coin side, have been focused on the protocols, the blockchains, the L1s. That is where a lot of the opportunity has come from. A lot of the best gains have come from, and that's still where most of the market holds their assets and is invested in. My question is, do we need this many L1s? How many L1s will there be long term? And where will value accrue? We had a conversation in an episode that comes out tomorrow about the fat protocol thesis versus the fat app thesis. So I know I asked you a whole bunch of questions there, but would love to get your thoughts on where this goes long term.
Yeah. So I've actually been meaning to, I wrote a paper about this like 4 years ago at this point, almost 5 years ago, for our LPs back in 2020. Which I can walk you through. And I should really put it up as like a blog post and a tweet thread that explains this. So maybe this is a good catalyst to do that.
That would be great.
And so, yeah, thanks for the nudge. So, maybe I can walk through kind of like how we think about the market structure, and then that also touches on kind of like L1s. So, okay, so imagine like left to right. Left is where the user is, right? And so there's like an interface and some application that the user needs to use, and below that is like the some SDKs and some way to wire around smart contracts and maybe some like custody infrastructure. And then some DeFi protocols to move assets around and do swaps and whatever, whether it's lending or Uniswap or whatever. And then on the other side is maybe, where's the liquidity sitting? It's like on like multi-chain infrastructure. And so maybe that's like, you're sitting on an L2 or something, or bridges. And then below that is sort of the L1s. And then below that is like the physical hardware, AWS or whatever data centers, and below that is like the NVIDIA chips or the Qualcomm chips or whatever that the stuff runs on, right? So that's like the full, in sense, of value chain, and even maybe beyond the chips are like the fabs, right? Like that make the chips, right? So that's kind of like your whole value chain of like how does an app actually interact with the user on one end, all the way to like the chips getting made on the other. So that's your x-axis. Now think about your y-axis, which is who captures all the value, right? And what you realize is if you sort of take that line and you start to put the value on it, that you get sort of a U shape, right? Like the ends sort of come up to max value, and min value is sort of in the middle somewhere. And what that means is, if you have the end user relationship and you have the brand and you have something that people think of and associate with value directly, there's a real moat there. And if you're all the way on the other end of it, like the closer you can get to NVIDIA and TSMC or like running the hardware, these are like really, really, really heavy CapEx businesses. That's a massive moat. Like building something like that requires, at this point, tens of billions, hundreds of billions of dollars, tremendous engineering, years and years of expertise, and that's a real moat. And the sort of moat that you have in your business and value capture sort of goes down the closer you get to the middle. And if you get like a smart contract protocol that two people can build and it just routes money around and doesn't really hold any money or assets or have any brand, that's sort of min value. And what you realize, and this happens in every industry, right? So like you have, let's say Facebook, TikTok, on one end, they own the end user relationships, and sort of like, there's some defensibility with some of the SDKs in the middle. And when you get, to like true, like, I don't know who's making Android headset, phones. I don't know like who these people are that are like assembling stuff, and most of them probably are not that valuable. And then all the way on the other end, you have like Apple making silicon, and TSMC and Qualcomm and ARM. You see it with like Tesla on one end, and like Mobileye on the other end, and like people who assemble cars in the middle probably don't capture a lot of value. So you see it in a lot of industries. And so in crypto, the far left end, which is like who owns the user relationship, are folks like Coinbase and Binance, right? You have KYC, you have a real user relationship, you have fiat on ramps and off ramps. It's like a grind of a business to build. But if you have that business, you have a real customer relationship. And all the way on the other end, in my opinion, are the L1s. And so like L2s are slightly less valuable than the L1s, and have less of a moat, and like, sort of dumb DeFi apps that don't really have any sort of network effects are sort of even lower. And so if you take some sort of protocol like in the middle, let's say something like Uniswap, yeah, there's a little bit of a moat and a little bit of network effect. And if you're an early venture investor, you can still make money there. But like once it's a listed token, how much upside do you really have from there? And what you realize very quickly is that the incentive for these companies is to kind of go up both sides of the curve, right? And so Uniswap Labs, which owns the interface to Uniswap, the protocol, has an incentive to go up the left and start to look more and more like Coinbase, right? Like they really need to own the end user relationship and have a moat there. So there's a natural incentive for them to list more and more assets, and eventually potentially like try to do KYC and sort of have these sorts of relationships with the end customer, and that's sort of where they want to go. And at the same time, there's also an incentive for Uniswap, the protocol, to move up the right side of the curve, right? To become an L2 and maybe eventually to become an L1, capture all that sequencer revenue or that MEV. Maybe you pass it back to the users, maybe you keep some of it, but that's their natural incentive structure. And so you can see actually, and we wrote this like 5 years ago, and I think it's been actually pretty accurate at sort of calling what the incentive structures are for all these different protocols. When you look at it through that lens, you realize that actually it's not just a fat protocol thesis, it's actually a fat L1 thesis and a fat app thesis, which is like if you have the end user relationship, you can capture a lot of value. And if you have an L1, like an Ethereum or a Solana, or a Near, you can capture a lot of value. And a lot of the stuff in the middle just will get squeezed. And over time, those things in between will realize they need to sort of move up either the left or the right part of the curve. And so if you look at it through that lens, I think it's not a fat protocol thesis per se. It's more of a fat L1 thesis and a fat app thesis. And then when you zoom into the L1s or the apps, I think you realize that in different markets, you have different needs. So like Coinbase can't serve everybody in the world or every type of user. And so if you're going to have billions and billions of users, you're going to have multiple kinds of apps. And the same thing for the L1s. Like I don't think there's going to be one L1 that solves all the problems. And I think the different technical constraints of the L1s will lead there to be massive fragmentation. And even though these are like very network effect driven things, like an L1 has a lot of network effects around it. If you look at the most network effect driven things like payment networks or social networks, literally they have the word network built in, right? Even there you see tremendous fragmentation, right? Like had Facebook not bought Instagram and WhatsApp, you would have Facebook, you'd have Instagram, you'd have WhatsApp, TikTok, Telegram, Twitter, LinkedIn. Then you start going internationally, you have Kakao Talk, vKontacte. Like, you realize that at scale, Snap, like at scale, you get segmentation by user types and you get regional and community-based segmentation. And so I tend to think that, obviously not financial advice, but I tend to think you're actually going to have a lot of L1s because the technical constraints will lead people in different directions, and different communities will sort of want to make different trade-offs in the technology, and therefore they will embrace these things. And at 2 to 5 billion people using these things, I think it's very unlikely that you have only one network. You probably have something more that looks like a power law, where there is obviously a big one, but there are probably a dozen others that are really, really useful. And so what we're often looking for when we're looking at these things is like, is there sufficient differentiation? Like, is the technology sufficiently differentiated that lets you do different things, or is the community so differentiated that over time they're just going to make really, really different trade-offs about what they want the technology to do or what kind of applications are possible, and that will lead to sort of fragmentation over time.
So let's talk about how this could play out on either side. And I love the way you've taken us through this. On the fat L1 side, we have a lot of general purpose L1s right now. Is is it going to be the general purpose L1s that maybe find their niche and target a specific segment? Is that how we'll have these L1s will continue? Because it doesn't feel like we can just keep on putting out general purpose L1s and they'll all succeed, right? And then on the app side, is it going to be a a Web2 app like a Robinhood that already has the user relationships and they'll be the ones that control most of the users? Or is it going to be, or maybe is it going to be new apps that we just don't know yet? How do you see it playing out long term? Or I guess the other question is, or is it more like Hype's model, Hyperliquid, which was an app and had the users and then went and built the L1 because that was they had the ability to
Yeah.
build a specific L1 for their users.
Yeah. The short answer is it could be any of those. And in startups and in technology, success is an anti-pattern, right? Like the default case is actually failure. And so basically all of those paths will fail. But at the same time, all of those paths are potentially successful paths. And so it's really more a function, in my opinion, of rather than, at least the way we think about it is, rather than saying this particular path is the right path, or that you have to do a specific application and then grow into an L2 and then grow into an L1, or oh no, there's no way that an L1 that tries to be a platform from the get-go could possibly win, and therefore, like, Monad doesn't have a shot. We're investors in Monad. We think they certainly have a shot. They're doing a phenomenal job. Like all of these are viable paths. What really matters is, are the people that are building it capable of executing on that? And do they have a reason to believe that that is the right way to go? And do they have a plan to execute against that? And so, hey, I have a specific app and I'm going to make that an app and a killer app. Yeah, that's great. If you can build a killer app and you're really good at that, and then the risk becomes, well, can you generalize that? Is the type of team that's building a very specific app also really good at building a generalized platform? Often that's not been the case. You can see Facebook tried to do this many, many times, for example, and they failed. Whereas Microsoft did build an operating system, and then they also built things like Word, right, and the Office suite. And so they were able to build specific applications and platforms. Amazon was able to build a specific app, and then they turned it into a giant platform. And so, it could work both ways. And I think with the Web2 versus Web3, kind of same thought. Like there will be some businesses that, take like a Fidelity, which is a family-owned business. It's an old legacy business that is actually transitioning to this world quite well. Or look at BlackRock and what Larry Fink has done. He's actually sort of transitioning to this world remarkably well. Many other businesses will not be able to do that. And there will be some businesses that are like a Robinhood. If you look at what Vlad has done in the last couple of years and sort of transforming that business from a Web2 to sort of like a hybrid Web2, Web3 business. And so much of their volume now comes through crypto and crypto adjacent things. To Coinbase, which is starting sort of, more Web3-ish and sort of, moving more traditional, to, I think, the next gen dexes. It's entirely possible. I think if you look at like a Magic Eden or a Slingshot and you look under the hood, they're built on a lot of decentralized protocols, right? So like the way that the technology stack looks a lot more like a Web3 business. It's just sort of packaged up in a way that Web2 people can understand. All of those are viable paths. And a lot of it depends on the founders. A lot of it depends on execution. A lot of it depends on market timing and kind of what's shaking out in market. So rather than being strongly opinionated about which of those it's going to be, well, what we tend to do is try to look at it case by case and say, like, is this group of people that's pursuing this path capable of executing on this plan? Do they have a credible plan? And are they capable of executing on that plan? And then I think any of those are viable paths depending on who's on your team and the way the world sort of stacks out over the next couple of years.
Are are we over allocated to L1s right now?
That's an interesting question. I think for a lot of things, whether you're talking L1s or you're talking about like the AI vaporware meme coins, you could have made this argument about DeFi a few years ago and potentially even today. I think there's a time horizon question. And so the way that there's this saying, I think it might be a Bill Gates quote, but I don't remember, which is effectively people dramatically overestimate what's possible in 2 years and dramatically underestimate what's possible in 10 years. And so when I think you look at things like L1s, you might argue that like there's no way, if you look at the cash flows of some of these things, that they should be worth what they're worth today. I think that's the wrong lens, right? I think it's what's really happening is the market is saying, I think this is going to take off in 2 years, or I think in 2 years it'll be huge. I'm projecting some growth curve. And that's probably too optimistic. But if you're willing to hold for 5 or 10 years, maybe that's actually a great investment. Maybe that there's a real opportunity there because on a 2 to 5 year time horizon, people are actually not optimistic enough. I tend to think similarly about a lot of this AI stuff. I think people probably in the short term are too optimistic about what these AI tools can do. Like if you've written code with Cursor or O1 or Claude, Sonnet or whatever, you get 80% of the way there, and then you start hitting the sort of the fringes of it, and you're like, oh, actually, it's got some ways to go. But you can see that over 7 to 10 years, it's going to be amazing, right? And so I think we're kind of the L1s are sort of in that spot right now, which is like probably a lot of people are expecting them to do things that they just won't be able to do in the next 2 to 3 years. But over 10 years, I think a lot of these things are, if the teams are committed and they keep grinding, I think these things could be huge. And again, you could have said the same thing about mobile phones. You could have said the same thing about self-driving cars. Like I was an investor in a company called Cruise, which unfortunately GM shut down after acquiring them. And at one point it was worth like $30 billion. But when we invested in Cruise and self-driving cars in like 2014, people are like, oh, we're going to have self-driving cars in 2 or 3 years, right? And like Cruise could get on the highway and was 80% of the way there in like 18 months. And then it took another 8 years for them to get the rest of the 20%, right? But now literally you can take a Waymo in San Francisco, a self-driving car that gets around the city and is better than an Uber. And they're now beta and getting down to SFO from to the airport, and that's remarkable. And it was just about 10 years, right? So like the adage played out almost perfectly in that case, if you know the history of self-driving, right? And so I think we're just kind of in the middle of that with the L1s right now. People have been like way too optimistic about how big these things can get, and then a bunch of them don't have any usage. But now the infrastructure is real, and so I would not be surprised to see these things actually end up being much bigger than people expect over the next 7 to 10 years.
Okay, you bring up crypto and AI. I want to touch on that before we let you go. Is it all vaporware? Is right now, like not long term. I know long term you can't predict the future, but it's clear that there's something there long term. But right now, is it all vaporware? Is it completely overhyped?
I think it's like 98% vaporware. So almost entirely vaporware. I think there's some pockets that are definitely not vaporware. I think a lot of the stuff that like the Near ecosystem is building, if anybody knows that ecosystem, Ilya Polasukin, not Ilya Sutskever, but Ilya from Near was also one of the authors on the Transformer paper from Google, the attention is all you need paper that created, modern transformers and LLMs. And they built phenomenal infrastructure that basically makes it really, really easy for any smart contract to write, control assets across chains. And they just did a bunch of launches yesterday, which I haven't had a chance to dig into, but they're really marching towards this idea that like the ultimate consumer of blockchain infrastructure is AI. Like what you really, like AI is not going to use Visa. It's not going to use Swift. That just doesn't make sense. You need a 24/7 real-time payment system that can handle micropayments and it has smart contracts built in so that AI agents can talk to each other and make commitments to each other. If you look at Eigenlayer, and just for disclosure, we're investors in both Near and Eigenlayer. But if you look at what Shriram is built, he has this very strong thesis, and the Eigenlayer crew does around the ability to have trust and the ability to make cryptographic commitments is even more important for AI agents than it is for humans, because AI agents don't have an alternative. Like you and I can create a contract in the state of Delaware, we can both sign it. AI agents can't do that. And so software that needs to make commitments to each other needs something like an Eigenlayer to be able to make these kind of cryptographic commitments and have them backed by trust. And so, if you look at, I think there's some really interesting stuff happening around TEE networks and trusted execution environments. There's really interesting stuff. And so things like Fala or Succinct, Tonk, like there are these really interesting sort of networks of computational hardware. And I think proof generation is going to be a thing that all software needs to do, including AI software. So if you assume all software becomes AI software, the ability to tap into a compute network and generate zero knowledge proofs or to use trusted execution environments to perform transactions, I think is just like a basic building block that all software will need. So I think there are like pockets of really interesting infrastructure that have been built that will get used by AI infrastructure over time. But a lot of the AI meme coin stuff, if it's like an LLM that's wired up to Twitter and is like tweeting out, I think it's a super interesting experiment. but I think it's probably worth a lot less in like pure financial terms than most people think it is,
Mhm. Mhm.
and with no real value capture in the short term.
Right. Now, does that mean that uh, when we look at the rest of this year, as if if you're an investor in the space, not a not from a VC perspective where I know your time horizons are much longer, but a retail investor, if you're the guy at the grocery store,
Yeah.
uh, is there still opportunity
Yeah.
for these AI tokens to do very well?
Well, not financial advice. Obviously, everybody should do their own research. But I kind of think of it slightly differently, almost, which is I don't think of these things as investments at all. Like, I think the right way to think about this stuff is kind of like we're talking about the guy stocking the shelves. Is like probably people are under allocated to Bitcoin. Probably people, you could reasonably make an argument that having some like ETH and Sol and Near, like really high quality stuff, is like reasonable with some very, very, very small percentage of your net worth. And anything beyond that really should be seen as a tuition check, right? Like for most people, you're not if you're just starting from like a low capital base, the odds that you're going to be able to compound that in a short term into a meaningful capital amount, just very, very, very small. You're basically playing the lottery. And if you're going to play the lottery, you should size your tickets, assuming you're going to lose it all and you're playing the lottery. But I think if you think of it slightly differently, which is not that it's lottery tickets or not that it's an investment, but that it's a tuition check, I think it can actually be quite lucrative over time. Because back to this idea that like if you are trying these technologies, if you're learning about them, if you're learning about how to use them, you're actually investing in yourself, right? You're learning how to use these technologies and being prepared for the future. So the analogy here might be, if you were in the mid 90s and you saw Amazon happening or eBay happening, like the move was not to try to like speculate on internet stocks. Like maybe you could have done that, but odds are you probably would have lost money. I think the move was, wait, how does the internet work? How does email get routed? How does e-commerce actually work? Can I sell some stuff on eBay and build an intuition for how this e-commerce marketplace kind of stuff is going to work? Can I go and buy a subscription to something? Oh, wow, payments are really broken on the internet. What does that mean? Right. And once you start using it, you start realizing all the places that it's broken. And then you're sort of living in the future by 10 years. And I think that makes you more employable. That means your earning potential goes up. And so now you actually have a shot at sort of, having a positive ROI. I think if you look at it as sort of like an investment of your time into learning rather than like a monetary investment. I think for most people, I mean, if you have less than like $1 million disposable, like you probably should not be trying to like allocate checks into these like longer tail tokens. I think it's just you're more likely than not you're going to lose your money. But I think of it, yeah, I think looking at it as like an investment, I think is the right way to look at it, and of your time, right? Like
Your time.
can you learn
Yeah.
a bunch and be 10 years ahead of everybody else, which from like a job and earning potentials perspective might actually make you more money. And then once you have enough disposable income, you can start to invest.
It sounds so simple. Like I want to clip that wisdom right
Yeah.
there and
Well,
put it out to everybody.
it goes
but
back. I
but
think it,
but people won't do it. Human behavior will not lead people to do that.
yeah, yeah. I think it's either a Charlie Munger quote or a Warren Buffett quote, but it's effectively like nobody wants to get rich slowly. Like everybody can get rich. It's just like getting rich slowly is really, really hard. Everybody wants to get rich fast. And I think that's true. I also think there's a meta lesson in there, which is like, I'm a venture investor and we do crypto, which is like, the highest of all stuff. And if like a crypto venture investor or a venture investor is saying the same thing as like a value investor, like a 95-year-old Warren Buffett, and they're saying the same thing, there's probably some ground truth there, right? And so like, that's what I really like about reading Munger or Buffett or stuff. It's just like they're in a totally different um, ecosystem, but like if they sort of have like converged on something that I also think is true, that's like the stuff that I really highlight. And I think this is one of them. Is I think most people should not be speculating with dollars that they have. They should be using the dollars as leverage on learning, and that learning is more likely to yield more dollars in the future than the actual dollars that they could invest today, and
Mhm.
probably like 98% of cases.
Damn, I think we got another show here, like a tuition check show,
Tuition
right?
check,
Like
yeah,
something about how to pay for your education with experience,
yeah,
right? And
yeah,
financial education is so important, and
I
most
agree,
people don't get it in
I
an
agree,
adequate way. I mean, let alone in the developed world, like and the undeveloped world. I mean, gosh.
yeah, I totally
So
agree.
it's yeah, wow. Well said. Avichal, it's been an absolute pleasure to have you on the show today. Thank you so much for all your wisdom. We really appreciate it.
My pleasure. Good to see you.
Thanks for listening in, everybody. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.